Gold has fascinated humanity for thousands of years. Long before paper money, digital banking, or cryptocurrencies existed, gold served as a trusted store of wealth and a symbol of financial security. Even today, in an age dominated by technology and electronic transactions, gold continues to play a unique role in the global economy. Whenever financial uncertainty rises, inflation accelerates, or geopolitical tensions increase, investors often turn to gold as a safe haven asset. In recent years, gold has once again attracted significant attention. As prices have reached historic highs, central banks have increased their purchases, and economic uncertainty has spread across the globe. Yet despite these powerful signals, many everyday investors continue to focus almost entirely on stocks, cryptocurrencies, and other fast-moving assets, while overlooking what gold may be telling us about the broader financial system. Is gold simply becoming more valuable, or is it sending an important warning about the global economy? While no one can predict the future with certainty, history has repeatedly shown that gold often reacts before major economic events unfold. Understanding these signals could help investors make better-informed financial decisions and prepare for potential market changes, rather than being caught off guard. Today, we will talk about gold is sending a warning most investors are ignoring it. So, before we start, make sure to hit the like button and subscribe to my channel. Why gold has always been considered a safe haven. Gold has earned its reputation as a safe haven asset because it possesses qualities that very few financial assets can match. Unlike paper currencies, gold cannot be printed by governments whenever they choose. Unlike corporate stocks, it does not depend on a company's earnings or management decisions. Unlike bonds, it carries no credit risk because it is not someone else's promise to repay a debt. Gold exists as a tangible asset with intrinsic value, and its supply grows only gradually through mining. These characteristics have helped gold preserve purchasing power across centuries, making it attractive during periods of financial uncertainty. Gold often moves before the economy changes. One of the most interesting characteristics of gold is that it frequently reacts before major economic events become obvious to the general public. Investors who closely monitor economic data, interest rates, inflation trends, and geopolitical developments often increase their gold holdings when they anticipate future instability. As demand rises, gold prices can begin climbing long before recessions, stock market corrections, or financial crises officially occur. This is why many experienced investors consider gold an important economic indicator, rather than simply another commodity. Central banks are buying more gold than ever. One of the strongest signals many investors overlook is the aggressive purchasing activity by central banks around the world. Countries continue adding large amounts of gold to their national reserves. Central banks hold gold because it provides diversification, strengthens confidence in national reserves, and reduces dependence on foreign currencies. Increased gold buying by governments suggests that many policymakers are preparing for an uncertain global financial environment. When institutions managing national economies accumulate gold at historically high levels, individual investors often wonder whether they should pay closer attention. Inflation remains a major concern. Inflation gradually reduces the purchasing power of money. When prices for goods and services continue rising, each dollar buys less than it did before. Gold has historically been viewed as a hedge against inflation because its value often rises during periods when currencies lose purchasing power. Although the relationship between gold and inflation is not perfect in every short-term period, many long-term investors continue viewing gold as a way to preserve wealth when inflation remains elevated over several years. Government debt is reaching record levels around the world. Governments have accumulated enormous amounts of debt. Financing this debt requires continued borrowing, higher taxes, spending adjustments, or expansion of the money supply. Investors closely monitor debt levels because excessive borrowing can influence inflation, interest rates, currency values, and long-term economic stability. Gold often attracts attention during periods when concerns about fiscal sustainability increase, because it exists outside the traditional government financial system. Currency weakness can benefit gold. Gold is typically priced in US dollars, but its value often reflects confidence in currencies worldwide. When investors become concerned that paper currencies may lose purchasing power due to inflation or excessive money creation, they frequently seek assets with limited supply. Gold's scarcity makes it attractive during periods of declining confidence in fiat currencies. This does not necessarily mean currencies will collapse, but it explains why gold often performs well when confidence weakens. Geopolitical tensions drive safe haven demand. Political uncertainty has always influenced financial markets. International conflicts, trade disputes, sanctions, military tensions, and diplomatic uncertainty can all increase investor demand for safe assets. During periods of heightened geopolitical risk, gold often benefits because it has historically maintained value regardless of political developments. Investors seeking stability may allocate part of their portfolios to gold until uncertainty declines. Interest rates and gold have a complex relationship. Interest rates play a significant role in determining gold prices. When central banks raise interest rates aggressively, fixed income investments such as government bonds may become more attractive because they offer higher yields. Since gold does not generate interest or dividends, higher interest rates can sometimes reduce investor demand. However, if investors believe higher interest rates will eventually slow economic growth or trigger recession, gold demand may increase again. This demonstrates that gold responds not only to current interest rates, but also to expectations about future economic conditions. Gold and stock markets do not always move together. Many investors mistakenly assume that gold always rises when stocks fall, or falls when stocks rise. In reality, the relationship is much more complicated. There have been periods when both stocks and gold appreciated simultaneously, as well as times when both declined together. However, gold often provides diversification because its price drivers differ from those affecting corporate earnings. Including gold within a diversified portfolio may help reduce overall volatility during certain market conditions. Why institutional investors continue watching gold. Large investment firms, hedge funds, pension funds, and wealth managers carefully monitor gold prices as part of their macroeconomic analysis. Rising gold prices sometimes reflect growing concerns about inflation, financial instability, or weakening confidence in traditional assets. Institutional investors rarely rely on a single indicator, but gold often serves as one important piece of a much larger economic puzzle. Gold is also influenced by supply and demand. Although economic conditions receive most of the attention, physical supply and demand also affect gold prices. Mining production grows slowly, because discovering and developing new gold mines requires enormous investments and many years of exploration. At the same time, demand comes from jewelry manufacturing, technology industries, investment funds, central banks, and individual investors. If demand increases faster than supply, prices may rise accordingly. Why many retail investors ignore gold despite gold's long history? Many individual investors overlook it because it often appears less exciting than rapidly growing technology stocks or cryptocurrencies. Gold typically does not produce dramatic overnight gains or generate quarterly earnings reports that attract headlines. Instead, it often performs its strongest role during periods when other investments experience significant stress. Unfortunately, many investors only begin paying attention to gold after financial uncertainty has already intensified. If you liked this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.